There's been an awful lot of talk in the media about tax avoidance with the various schemes, Gary Barlow, Chris Moyles, Jimmy Carr, of course, and people do seem to be moving away from that. But that still leaves an awful lot of entirely above board tax planning opportunities that people tend to ignore, I think, these days, and think that, unless you're going to involve something that involves the Cayman Islands and at least 15 trusts, you're probably wasting your time. There's still an awful lot of ideas that can be picked up on, aren't there?
Oh, very much so, Giles. And we've got to distinguish between the illegal activity of tax evasion, nobody's going to condone that, aggressive tax avoidance schemes, such as the ones you've referred to, and I think that many of us for some time now have wanted not to be involved in those, and the cuckoos have come home to roost in a fairly dramatic way in recent months on those. And then there is what you and I talk about very frequently, which is tax planning, and it ranges from fairly simple ideas, such as involving division of income and assets between husband and wife, for example, to make sure that each of them enjoys their personal allowance and basic rate band. Next year, we'll have the savings rate of 0% on the first 5,000 of income. Now, here's a new idea for next year, which is simple tax planning. A director shareholder of a one-man company with no employees. Next year, we might advise a strategy of lending 50,000 to your own company, taking directors' fees of, say, 10,500 covered by the personal allowance, and then taking a 10% return of interest on the 50,000, 5,000 of interest tax-free before you take dividends. Some will be in a position to do that, some not. It is what you and I would call straightforward tax planning.
And it is the difference there between having a salary, let's say up to the top of the basic band, which would suffer 20% tax, 11% national insurance, 13.8% employers' national insurance, as opposed to 0% on the £5,000 and then effectively 0% on the dividends as well.
Exactly.
So,
now, we're only talking a few hundred or a couple of £1,000 saving overall in that sort of situation, but there are other tax planning ideas where many, many thousands of pounds could be saved. And if we move on to something like inheritance tax, a simple portfolio of AIM shares, alternative investment market shares, will give you inheritance tax cover once you've held them for 2 years, as long as they're trading company shares listed on AIM, then they qualify for 100% relief from inheritance tax. And again, next year, we should be able more effectively to exploit that through ISA portfolios. If you've got a significant ISA portfolio, there are, I gather, 7 in the UK with ISA portfolios of over 1 million. But frequently I come across accountants who've got clients with 6-figure ISA portfolios. 200,000 or 300,000 is not at all unusual. Well, 40% inheritance tax on that would hurt, but if it's invested in AIM shares, then that could get IHT cover.
So IHT covered. We've also got the income tax we talk about in terms of businesses. Of course, how you structure your business can have huge consequences. Corporate, partnership, when you buy your assets, how you buy the assets.
It's what you and I would call tax planning. And there's no question of the revenue trying to challenge that sort of arrangement. You're structuring your affairs in a sensible, tax efficient way. And that's what most of the accountants you and I talk to like to advise clients on, not on the rather more exotic avoidance schemes that have had such a bad press recently.
I always say the difference between tax planning and tax avoidance is that with tax planning, you know where you're trying to get to. You're looking for a tax efficient way of doing it. If you are only going somewhere because of the tax avoidance that will occur, then that's when you've crossed a line.
You're making an unnecessary journey.
Exactly right. And each year Rothmans publish their guide to tax planning, and that has just come out, well worth a look, and also well worth speaking to the team at Rothmans and making sure that you have considered the options and then got proper advice before actually implementing them.